Hi, Carol.
Hi, and welcome everybody. My name is Carol Golden, and I am serving as the Executive Director of the Limited and Extended Care Planning Center, better known as the NAIFA LECP Center. The center is an interactive hub where advisors can learn from experts about the various planning, insurance options to help your clients prepare for an unexpected or even an immediate extended or long-term care need. The resources navigation bar, it helps you to explore the many topics that will help you grow your business by making you more knowledgeable on the entire subject. It has interviews, articles, webinars, and white papers, trends. We hope that you'll be a regular visitor to lecp.naifa.org/subscribe. And by the way, the subscription is free. And as the executive director, I personally welcome any suggestions you may have concerning subject matter, ideas, thought leadership topics that you would like to see on the site. I can be reached directly at cgolden@naifa.org. Today, it's my distinct pleasure to welcome Tom Ritzky. As the Managing Director of LTCI Partners, Tom leads one of the largest insurance distributors focused exclusively on long-term care planning. Tom has been working in long-term care insurance industry since 1991. Tom is a graduate of Hope College and has an MBA from the University of Illinois at Chicago. In addition, Tom holds the Certified Employee Benefits Specialist designation from IFEBP and the Wharton School. Additionally, he's a chartered financial consultant and chartered life underwriter and holds those designations from the American College of Financial Services. Tom is also a member of NAIFA, yay, and NAHU, and is currently president of the Chicago chapter of the International Society of Certified Employee Specialists. The title of today's webinar is The Surprising Similarities Between Traditional LTC and Some of the New LTC Life Plans, or Life LTC Plans. There are many misconceptions, and I hold some of those myself. So, Tom, I'm really looking forward to the clarity that I'm sure will come with this webinar. And this webinar will discuss the new combination life LTC plans and how they're similar to the LTC plans and vice versa. You'll discuss the list of similarities, how the products work, 3 key differences between the types of products, and why meaningful benefits can be affordable for a wide consumer market. So with no further ado, Tom, would you please take us through this?
You bet. Thanks, Carol. And I've shared my PowerPoint presentation screen. Can you see that, Carol?
Yes.
Okay, fantastic. Great. Thank you. I'm going to stop my video just so that I can focus on the PowerPoint and the presentation, and it's great to be here with you again, and really excited with the things that the LECP are working on. And this is a topic that I wanted to discuss today related to, traditional long-term care insurance and some of the newer life long-term care combination plans. Just for starters, that's my contact information if people need to get a hold of me after the presentation with any questions. Can also go to our website, ltcipartners.com, and learn a little more about our organization. As Carol mentioned, the only thing we do is long-term care insurance planning and focusing in the traditional and the linked life long-term care products. And so that's what I'd like to start out with, a little bit of a brief history of the traditional and linked life long-term care plans. Then look in the differences in some of the way the plan designs are currently. And then finally, a couple really interesting case studies we've recently done here at the office with some new products. Obviously, we're not going to name the particular carriers, but we've done some research, and it's really interesting to see what's happening right now. And we look forward to the questions as you go to the question and answer and type in some of those questions and ask as we go in. So first of all, I'd like to discuss a little bit about the traditional long-term care insurance marketplace, which has had its downs and ups and downs, and it's a little bit of a roller coaster, as we all know. You know, I think a little context is in order to look at that. You know, the first long-term care policies started to be sold in the late 70s and the 80s. And a lot of these policies were really sold to supplement gaps in Medicare. And interestingly enough, when I see proposals for Medicare for all, I always have, you know, a comfort in knowing that long-term care is kind of separate outside of Medicare in relation to it provides that long extended custodial care. And that's what the niche is when long-term care policies were first introduced, is they wanted policies that it would help and go beyond that 90-day of coverage they typically wanted. The initial policy designs, though, regulators really wanted a minimum loss ratio on policies, which for a policy that you may not trigger for a number of years is hard to do. And I think that led to a little more aggressive pricing than was necessary. And this rapid growth from 1990 to 2008 happened. We saw policies with low premiums, easier underwriting than they knew, real high benefits, and a lot of competition from carriers to gain market share. And after the financial crisis and the low interest rate environment, we did have a hangover with traditional long-term care insurance, kind of a slow decline in new product sales. A lot of carriers exited the business. There were some large in-force rate increases on those older policies. The new products are more expensive, and the regulators are pretty cautious about the market currently. But now I think we've got a period of stability after all this excitement we've had over a long period of time. We have a current mix of long-term care carriers, which include, you know, a mix of mutual and fraternal insurers with a real long-term perspective and desire to remain in this marketplace. The product we think is stably priced and is also offered in the workplace as well. And to give you a perspective of how many policies were sold in 2018, the most recent Milliman Broker World Long-Term Care Survey that recently was published showed about 56,000 policies were sold in 2018. So that's a little bit on the traditional side. Most people are familiar with how the products work, so I'm not going to go into details on that. One thing I do want to talk about as we do this presentation is discuss the, you know, the context of people's concern about rate increases on long-term care policies. And so if you look at a recent study through the Society of Actuaries, they actually show that products that were priced, you know, from 2014 on have a pretty low odds of getting a rate increase, these newer products, because they are a little more expensive and they've got more conservative assumptions out there. So this information from the Society of Actuaries and also the regulators gives you a little more confidence on the premium stability of the long-term traditional products being offered today. Okay, now let's talk a little bit about the evolution of the life long-term care combination plans. Plans have been around for a while as well, but early plans were focused on a single premium asset transfer approach. For example, a bank CD that was going to expire, a safe place to put your money with this addition of adding a long-term care acceleration and an extension of benefit rider onto the policy. Now we call them not just asset-based long-term care insurance, we call them linked or hybrid or combination long-term care plans. And the way you can really identify them is a couple ways. One, they often have care in the name and the product name. There's several carriers who have them, and they're a real competitive marketplace. You're seeing national advertising for the products as well. They offer a tax-qualified long-term care extension of benefit rider. So unlike a just simply a rider on a life policy that only accelerates the benefit, these offer an additional benefit in an extension above and beyond. They typically now offer automatic inflation coverage option, which is becoming more popular. And also, more often the premiums are separately displayed from the life insurance premium, so you can take advantage of some of the tax deductibility of long-term care insurance premiums. And again, according to the same Broker World Milliman survey, there were about 36,400 of these type of policies sold with the extension of benefit riders, the life with the extension of benefit riders, the linked or the combo products in 2018. So if you look at the overall market of products that focus on long-term care planning, about 60% or so of the sales are traditional LTC, and about 40% of these combination hybrid products, if my math is correct. So that's kind of where we're at currently. Really quickly, for those who might be more familiar with traditional long-term care and not as familiar with the combination linked products, here's an example of how a product may work. You've got a 50-year-old male who either pays a single premium of $126,000 or pays this premium over a period of several years in some circumstances. And that leads to a plan that offers $144,000 death benefit that is accelerated at $6,000 a month. That's the monthly long-term care benefit over 2 years. If that entire initial acceleration is exhausted, then an additional 4-year benefit kicks into place. Again, this is just one plan design, and there's many different types, but this is a 2-year acceleration of death benefit followed by a 4-year extension of long-term care benefit. So you end up with a total long-term care benefit pool of $432,000. So that's really the linked products in its simplest way. You know, the advantage, of course, with linked products as well is you've got that death benefit, but also if you change your mind, you can often get your premium back, or there's some cash surrender value with a linked life long-term care product or residual death. So both of these products really are aimed to solve the long-term care insurance and long-term care planning need. What they have in common is they aim to maximize the long-term care insurance benefit pool. That's first and foremost their primary method to allow people to plan for the cost of long-term care in the future. So the other similarities between both the traditional and the combination products is they offer tax-qualified long-term care insurance benefits. So this is something we're very familiar with from both the insurance professionals and consumers, in that you don't have to necessarily compare with the benefit triggers for policies. You know, policies are going to pay benefits when you've got 2 of 6 of activities of daily living or a long-term need from a cognitive impairment. So, and those benefits are tax-free. So that's really great that we've got tax-qualified long-term care benefits. And again, for those policies in which the premiums, long-term care premiums are separate, we do have some tax deductions often available for business owners, paying premiums through a health savings account, and it's a whole nother topic of the tax advantages of long-term care. What else do the plans have in common? Well, they provide comprehensive benefits at home, assisted living, or in skilled nursing. The difference between the home care benefits often have to do with whether a policy offers a reimbursement plan where it's reimbursing for the actual expenses, or a cash indemnity plan where a family may get cash that they can use however they want to do to pay for care to have somebody remain at home. But those options are available on both types of policies. There's also an inflation increase rider for benefits available. The most popular option is 3% compound, having the benefit increase at a 3% compounded rate. And again, that's something that both the traditional and the hybrid products offer. Because long-term care is a big component, the health underwriting is a part of these policies. And they typically have elimination periods for things like assisted living care or nursing home care. Some have an elimination period for home care as well, but often we see a 90-day elimination period or deductible period before benefits are paid, because that ties in well with some Medicare benefits that are often available. And so these are all very similar things. Okay, let's talk a little bit about the differences in some of the policies. First of all, just the policy type. A traditional policy is a health insurance policy, and regulated as a health insurance policy, where a linked hybrid or asset-based combination product is a life insurance policy type. So that's a difference. Although from how it works from a consumer's perspective, that shouldn't impact that as much. The premium guarantees are a large difference. Traditional long-term care insurance is a guaranteed renewable product that has premiums that are designed to remain level, but as we see, some of the pricing errors in the past have led to carriers having to go to the Department of Insurance and requesting sometimes significant rate increases. But regardless, you've got the ability to, as long as you pay the premium, keep the policy in force. Almost all of the long-term care asset-based products have guaranteed premiums, so and benefits, and that makes it very clear and provides a lot of clarity for a consumer when they look at it. A death benefit is a difference as well. Although traditional plans can offer a return of premium upon death benefit, and as we'll see in a future example, that can be a significant benefit for some people, where a death benefit is of course built into a life insurance policy. A cash surrender value, most traditional policies don't offer a cash surrender value if you decide to drop coverage after a number of years. One carrier does offer it, however, and we'll look at an example of that, where the life policy is built on the whole or universal life chassis will offer a cash surrender value that occurs. The pay periods. Typically, most traditional long-term care insurance is annual pay. You pay throughout the policyholder's lifetime, where most linked policies have a shorter pay period duration, often single pay, but there's also 10 pay, 15 pay options, pay to age 65, pay to age 90, pay to age 100. So there's a lot of different options out there for the asset-based products. Waiver of premium, if you go on claim, need a long-term care claim, again, most traditional products will waive your premium at that point. And some of the combination products will as well. Normally they don't do it for the life premium. Sometimes they do, and often it's available for the long-term care. So that's, again, these things like waiver of premium and the death benefit, there are some similarities as well between the two types of products. Big difference is the partnership eligibility. For traditional products in partnership states, you can get that benefit. I'm not going to go into a lot of detail into how the partnership plans work, but from a quick perspective, if you have a partnership eligible plan, that money that you use in your policy is not counted towards your estate for Medicaid planning purposes. So they can be a real nice benefit in states that offer that plan. I'm not aware of the combination products that currently offer partnership benefits, but maybe that's something that'll be on the regulators' radar screen to add that, because I think it would make sense. And finally, underwriting. Most traditional products just focus on that morbidity underwriting, things that may impact you in a long-term care claim, where the life combination products have to worry about morbidity and mortality risks. Okay, let's go into a comparison. So we'll spend a little bit of time looking at a comparison between, and these are recent illustrations I ran off of current products in the marketplace. And so you can get an idea of a side-by-side look at this case study for a 55-year-old female who's looking at long-term care insurance, maybe dealing with an aging parent who has dementia and understands, wow, this is expensive. I want to look at this. They might be a business owner who has some ability to deduct some premiums. So let's take a look at their options. So on the left, we've got a traditional long-term care insurance plan. And on the right, we've got a more recent hybrid life long-term care plan. The annual premiums for the traditional plan are about $4,700 annually. And for the hybrid plan, about $6,400 annually. The premium payment mode for the traditional, we're paying annual premiums for the life of the policyholder. For the hybrid, annual premiums to age 100. So for most people aren't going to be fortunate enough to live to age 100. A big difference here is as mentioned, the premium guarantees. The traditional products do not have the guaranteed premiums. They're guaranteed renewable and designed to remain level. And the hybrid life LTC plans are guaranteed typically. I did get a question about the slide that it might be a little hard to see because of the writing. So if there's a way that you can go into the screen and maximize it, I don't know, Carol, are you able to increase the size of the screen? This slide?
I don't know. I'll text while you keep going.
All right. Okay, I'll definitely try to, maybe I can do this a little bit if I increase it this way. It will help out to some degree.
Yeah, now if you can.
Okay.
Yeah, that's much easier to read. Thank you.
Thank you. Okay. Let me go down up here a little bit. We're talking about guaranteed premiums. Okay. Premiums waived upon claim. Yes, with the traditional policies, the premiums are waived if you are on a long-term care claim. And for the for the combination product, the life insurance premiums are not waived if you're on claim, but the long-term care insurance premiums are. And to give an example of what those premiums are, the long-term care insurance portion of the premium for the traditional plan is, of course, the entire premium amount, $36.
Tom, let me interrupt you for a moment, please. Sure. But the answer is for the attendees, if you click on View Options at the top of the screen, you can zoom into the screen so that Tom doesn't have to juggle back and forth.
Great.
Okay?
Then I'll go back to the full screen slide. Thank you. Okay. So the initial long-term care insurance benefit is the same, $4,500 a month, which can be used for home care, assisted living, or nursing home care. The initial benefit pool for this illustration we ran is $270,000 for both. Of course, there's no initial death benefit for traditional long-term care insurance, and there's a $108,000 death benefit for the hybrid product. We added inflation protection of 3% compound on both policies. So both the total monthly benefit and the total pool of dollars grow at 3% the annual rate. So at age 90, when care might be needed for this 55-year-old, you can see that they've got a monthly benefit of over $12,000 for long-term care. And they've got a total benefit pool of almost $800,000 for both of these policies because they're both growing at the same rate. The death benefit doesn't grow. That's still going to be $108,000 at age 90 for the hybrid plan. Don't have one on the traditional plan. There's no cash value on the traditional plan, and there's a cash value of $80,000 on the hybrid life long-term care plan. There's a minimum death benefit. So if this is all used for long-term care needs, there's still a $21,000 residual death benefit on this hybrid life long-term care plan. And we have a type of care plan available is a reimbursement, but with an optional cash on the traditional plan we ran, and a cash indemnity program for the hybrid life LTC. So I think at this point, the 55-year-old has a couple good options. If premium affordability is an issue and they don't necessarily have a life insurance need, if they're not concerned about the any type of cash value or life insurance benefit, maybe they want to, stay under this $5,000 and get a traditional long-term care insurance policy. But I think you can make a strong case for the hybrid product as well, because you've got a substantial cash surrender value. You've got a death benefit if you need it, and you've got the peace of mind of guaranteed premiums. But it's pretty interesting to see how similar the products are, really, when you look at it side by side like this. Carol, any comments on this?
Yes, as a matter of fact, what I was just going to ask you to address is when you have a cash indemnity program, which is good in many ways, but isn't there a daily or a monthly limit to the amount that you can use? The reimbursement naturally, usually with the traditional, only went to that amount. So with cash indemnity, yes, you can take more in a month, but isn't there a tax impact there?
In this case, not getting to that tax impact, because the tax rules allow for more than that monthly amount currently, and it's growing. So that normally increases here. So I mean, theoretically, it could happen in the future, but I think as long as you're getting, as long as the care costs, which will increase, I think you're going to be okay.
Good. I knew that was a question when I was, advising clients. They usually asked me about limitations, but I think, as you say, it grows, it gets inflated, and it's pretty generous anyway. But that is a big difference. In some cases, as we always say, the reimbursement has a little limitation, but it's usually not an issue, and the cash, which allows you to go ahead, you do have to be careful that if you go beyond it, you have to be mindful that there could be a tax impact.
Yep. Okay, let's take a look at another example. This is a 55-year-old couple, and they also had an experience with a long-term care claim. So they're interested in unlimited coverage, unlimited lifetime coverage, and are willing to spend a lot of money for this. So in this case, we've got two products, a traditional long-term care insurance plan and a hybrid life LTC plan. And I've got two premiums for the traditional, because I want to show you what the difference is when you add the return of premium and a surrender rider to this traditional product versus the hybrid. So you can see the traditional long-term care insurance premium without this return of premium and surrender rider is about $8,000 a year, and about $14,000 a year with the riders included. And the quote on the hybrid life long-term care plan with unlimited benefits is $14,500 for this couple. So these are both true joint policies that they share. The premium payment mode for the traditional, in this case, is annual premiums for the life, and for the hybrid is annual premiums to age 95. Again, the premium guarantees yes on the hybrid life long-term care and no on the traditional plan, but it's a newer product series, and they're guaranteed renewable and designed to remain level. Both offer waiver premium for a long-term care claim. The long-term care portion of the premium is $8,000 for the traditional plan and about $10,600 for the hybrid life long-term care plan. We've got a little bit, because this is more of a daily benefit, it's 170 a day or $5,100 a month compared to $5,000 a month. Included lifetime or unlimited coverage for both policies. Of course, the traditional does not offer a death benefit. The initial The death benefit is a survivorship, so second to die, death benefit of $166,000 in the hybrid product. 3% compound inflation protection, which is going to increase that monthly long-term care benefit at age 90 to over $16,000 for the traditional plan and $13,000, again with lifetime unlimited benefits. So at age 90, if they don't use any long-term care claims, and let's say the worst case scenario is where they're in a car crash together and they both die, the return of premium with the traditional plan in this case would be almost $500,000 because you're returning all these premiums over 35 years, where the hybrid plan is $166,000 death benefit. So again, this is a return of premium, but because it is return of premium on death, it works a lot like a life insurance policy. The cash surrender value with this traditional plan is 80% of the premiums if they like to surrender it. So it's also a substantial amount, $391,000 compared to $127,000 for the hybrid life LTC. There's no minimum death benefit, and these are both reimbursement for professional home care, 90-day elimination period. So, again, you're looking at very similar types of benefits, similar premiums, and it's just a matter of, when we ran some of these numbers, we're like, wow, you can really have a traditional product look like a combination product, kind of a reverse combination, hybrid life long-term care. And, the hybrid products are really competing on maximizing that long-term care benefit, including inflation options that increase it. So we found this really surprising. I think it reminds me of when there used to be an argument about, buying tax qualified versus non-tax qualified long-term care insurance a long time ago. And I think now that people who, say that traditional is better than hybrid or vice versa, I think they need to be a little more open-minded and nuanced and see that there could be a fit depending on the individual client situation. Obviously, the two examples we used were very expensive, but you can get affordability with the hybrid plans as well. They don't all have to be single premium. Here's an example of a 55-year-old female with an annual premium of $2,700 guaranteed to age 100. In this case, we've got a initial long-term care monthly benefit of $3,000 that'll grow to $7,000 by age 85 and keep growing. An initial benefit pool of $72,000 that'll grow to $172,000. And you have a nice death benefit and a cash surrender value as well. So these are meaningful benefits, and these can have a huge impact when a time happens when you might need care and an impact on a family. So there are price points for both traditional and hybrid products as well. And, this slide, I'm not going to go into details because we talked a lot about the issues, but it really shows that there's, 3 different market segments: traditional, the linked products, which are the 2 we talked about today. But there's also life insurance with a long-term care rider, which is the majority of the policies, long-term care policies sold are this model, which are very valuable, but they don't offer that extension of benefit riders and don't put as much of a focus on the long-term care benefit. They're more an add-on to the life insurance sale. Okay, so the takeaway when you're looking at working with a client and planning for long-term care is that if life insurance is still a primary need, you really want to look at other product types other than the traditional or the linked products. I think it's really important to determine the importance of the use it or lose it features of linked products or a traditional product with return of premium. How important is that? There is a cost, of course. So the death benefit and the surrender value are great to have, but they do at a cost. And many of the hybrid carriers have found that they're not getting a lot of people who are focused on the return of premium. So they're deciding to, again, put the focus on the long-term care benefit instead. Need to consider the importance of premium guarantees. So if people are really, even though you've explained, hey, these new products are more conservatively priced, don't compare them to products that were sold, 25 years ago. If people are really worried about premium guarantees, they may be willing to pay more for that peace of mind. Keeping a premium budget in mind and how to fund premiums is important. So that is important whether you're a business owner, whether you're using, we get a question on, required minimum distributions to pay for a plan. However you're going to fund that policy, that's important to keep in mind as well. So you can work backwards into, hey, we're going to look at our current income or a portion of our current savings to pay for a policy and find out what type of benefits we get out of there. And as you mentioned, Carol, the cash versus reimbursement is an important comparison as well. So that is all I have for today. I thought, and we're a great time now to be in the marketplace because there's a lot of options. Over carriers that we work with offer some of these very similar product features. But one thing that is not available is any type of easy underwriting on these policies. I mean, you've got to get them while you're healthy, and that's really an important message to get out to people before Friday.
Yeah, I would agree, Tom. They always say that it's your health that actually buys you the insurance. I see that we do have some questions. Would you like to address them at this time? I also would encourage you to remind us of how to reach you directly. One of the things that we designed into the NAIFA LECP Center is that you can reach out on the expert page. You'll see Tom's handsome face, and you can reach him directly through the LECP NAIFA site. But I think it's important to also recognize that not every advisor really wants to be the expert, but they want to go to another NAIFA member that they trust, someone who participates and supports NAIFA for advice and more details on what you were chatting about. Tom, I see that questions are coming in. I'll be quiet.
Let me answer for you. In our BDs used to pay plan premiums. Certainly, right now there's not a mechanism to have those not be taxed when you take those out. So, but they are a source to pay premiums. You will pay taxes like you normally would on that income. But the advantage with the long-term care premiums, tax qualified premiums, is you can take money out of a health savings account to pay premiums, which is really, really a great way to kind of pay with pre-tax dollars. So for people who are maximizing their HSA and their 401k, there will come a time when that will come in handy to help pay for these premiums and pay for care. Somebody asked if I identify the carriers for the comparisons. I didn't want to do it on the recorded line, but if somebody sends me an email or gives me a call, I'd be happy to say who we used for these comparisons. Okay. State guarantee pool coverage, traditional versus life products. Yeah, that's been a big change recently. Many states have recognized it's a problem. Some of the traditional carriers have been funding the long-term care pools, and knock on wood, we haven't had a liquidation event since Penn Treaty for a while. But I think that people are trying to get ahead of the issue in case there is a problem with a large carrier who's struggling, to make sure the state guarantee funds will be in place. So they've been getting, not just from carriers now, the life insurance carriers have also are going to be contributing to the state guarantee funds so that they can help. But I think, to my knowledge, the rider coverage, the long-term care rider, would have similar limits to a traditional plan for a state guarantee fund, which varies by state. And you can always Google state guarantee fund health insurance in a particular state, and it'll show those limits. In most states, it's like $300,000. So definitely that will play into the role when you get into higher dollar amounts, and it should play into the role. Make sure you've got a strong financial carrier when you're looking at it. And that's all we have right now, I believe, Carol. Yeah,
okay, well, let's give everyone another minute or two to think through whether they have any more questions. But I encourage you to contact Tom directly and start just talking about all these different options you had. You know, the the NAIFA LECP Center, we have included other funding options, whether you want to use the funding options to buy insurance or whether it's an immediate need or you feel that that's part of the entire planning scenario. I hope that you will subscribe, visit, and send me ideas that you think will be helpful for you to grow your practice. I want to repeat that you don't have to be the expert. Obviously, we have Tom and his partner Steve as experts, and they've been in the business a long time. That's why we can go through a little bit of history and understand all of the nuances that now the industry has spoken about, move towards developing new products that won't have the same sorts of challenges. So on behalf of Tom and myself, I would like to thank you for your time today, and we both hope to hear from you soon. Thank you.
Great. Thank you, Carol. Enjoyed it.